As American bond yields rise, debts are rapidly moving toward an unpayable point, and America's debt crisis is becoming a global debt crisis. With the rising interest rates worldwide, the unsustainable debt system is rapidly moving towards a great reset. But unfortunately, in the closest scenario, it seems that it will try to be resolved through wars, which is the least desirable and most dramatic outcome. This is a result we have been expressing for a long time. We hope that these issues will be connected to more positive things sooner rather than later. Unfortunately, in the history of world politics and economics, these phenomena are never absent. This week, we will reevaluate developments in precious metals, commodity markets, and the bond market. Let's get started. As American bond yields continue to rise, they have now reached 4.8% for 10-year U.S. Treasury bonds. We had predicted this because they needlessly prolonged staying at 0%, which caused the debt structure to become unpayable and created a significant bubble within it. This bubble extended to various markets such as the stock market and cryptocurrencies, causing a everything bubble. Eventually, this bubble had to burst. China was among the first to notice this and burst its own bubble. So now, China is trying to recover from the bottom and correct the situation, and they might achieve prosperity before the rest of the world. However, the world will continue to face difficulties in this high-interest environment. But let me reiterate, this is a major transformation process that won't happen overnight. It will unfold over the long term. I've been talking about this for a while, and in these videos, especially in the second video of the week, I discuss this phenomenon extensively so that it becomes clear. Because gold and silver prices didn't rise overnight, discussions based on their recent increases are futile. What's important is what will happen in the long term. Precious metal investment is something that should be considered over the long term. We are explaining short-term trading here for those who want to trade weekly, but the big picture is different. In that sense, it's not necessarily an investment. You can choose whether or not to invest in it, and you don't have to watch it closely. I'm just presenting the global perspective I see, and unfortunately, the unpleasant consequences are gradually emerging. We talked about the possibility of wars, and step by step, they are happening. Now, let's talk about the dollar, the biggest rival of precious metals. Look at the dramatic situation of the dollar. The drop in the bond market is so severe that there has been a 46% drop in 10-year bonds from their peak. When interest rates rise, bond prices fall. So, if you invested $100,000 in American 10-year bonds, you now have $54,000 left. If you need the money today, you will only get $54,000. This damage is not like the gold I bought at $1,900 and it dropped to $1,850. It's a huge loss, and I've been trying to explain this for a long time. I will even show a graph of this decline shortly. Even the drops during the 2008 crisis were not as significant. 30-year bonds have seen a 53% drop, so if you invested $100,000, you now have $47,000 left. If you want to get out, you won't have to wait for 30 years, but it might still take a long time. So, the damage is substantial. These bonds are invested in trillions worldwide, and America's debt is in trillions of dollars. Therefore, this problem is enormous. It's not a matter of 3 or 5 days. You can't simply say, "What will happen to the dollar? It's strong, it's the king of the world." America can't sell these bonds anymore, and countries around the world are trying to get rid of them. This is partly responsible for the concessions being made, and China, for example, continues to sell its holdings. From 2021 to the present, China has sold $300 billion worth of bonds, trying to sell them to its own people and allies, which causes problems because they need them to support their economy. So, there's this ugly and disgusting situation, but it's the reality. On the other hand, America's debt continues to grow at an alarming rate. It increased by $275 billion in just one day this week, reaching a staggering $33.442 trillion. This is an incredible number, and it keeps growing. This debt growth is not normal. Normally, over many years, it should be proportional to GDP, but there has been a significant change in momentum since the 2008 crisis. The debt is growing at an accelerating rate, and it has been widening for a long time. So, the size of this debt will reach an astonishing point where it can't be repaid. Regarding gold, last week we saw a sharp decline, and it reached oversold levels not seen since 2018. I have a graph that shows this, and I've been increasing my physical holdings in gold and silver, especially in recent weeks. Central banks around the world have been continuing their purchases, with 77 tons of gold bought in August alone. Central banks are consistently increasing their gold holdings every month, as the data shows. Gold, last week's candlestick is showing a very positive sign, a bullish engulfing candlestick on the daily chart. In that regard, we will consider the possibility that this might be the bottom. However, for the trend to turn into a buy signal, it needs to break above $1,860. We've retraced to $1,832, and by the end of the week, we reached $1,905, which is the 200-day moving average. If we manage to close the week above $1,900, it would signal a stronger trend. On the other hand, let's take another look at our long-term chart. There doesn't appear to be any significant changes for me, but I view this pressure as an opportunity. However, we need to get above $1,900 as soon as possible. If we can close the week above $1,900, it would be a signal that the movement toward our long-term and medium-term targets has begun. Until then, all I've been talking about is a horizontal product with pullbacks and increases. I see this as an opportunity for long-term buying at even lower levels, but we'll need to wait for these signals, at least for medium-term movements. Silver had a better outlook in the last week, especially on the final day. As you may recall, I mentioned last week that they created this pressure while China was on holiday, thinking that China would return from its holiday. They even closed their short positions expecting that Monday would be a holiday in the United States. In that regard, silver closed the week at $21.59, and there's a bullish engulfing pattern on Friday at $21.52, which also produced a daily closing buy signal. Now, as long as we don't have daily closings below $21.52, silver's direction is likely to be upward, but it might involve some delays. The gold-silver ratio, closed at 84.80 and 84.70, is my trend tracking level. If it breaks below, the movement will start, and if it goes below 78, it will accelerate. So, we will closely monitor this during the week. We will see if the effects of these wars will have a positive impact on gold and silver. Normally, they should, and it should be significant, but sometimes, due to manipulation, we can't always understand. However, the fact that China is returning suggests that there will be high demand there, especially considering these tensions. Precious metals should react positively. Platinum is currently at $883, and I have a trend tracking level there. We're approaching it, and there's some pressure there. Compared to other metals, platinum has been weaker recently. However, if the movement starts, we expect it to outperform gold, as historically it has moved 10 to 20% higher than gold. But in the last 7 to 8 years, it has been trading at half the price of gold, which is interesting. Wheat, for those who have been following the portfolio basket, they may have noticed losses, especially in commodities like wheat. Well, if you wait, such commodities tend to have fluctuations. Because commodity investment works this way, you'll see when we get back to natural gas and uranium. Wheat is currently at $555, and I have a trend tracking level just below. I started adding more wheat positions this week, around $540. These levels seem very cheap to me, and I see a potential upward breakout from this pressure at some point, especially given the recent oversold conditions. If you look at the long-term chart of wheat, whenever it comes to this region, it has reacted upward from oversold conditions each time. Brent oil saw sharp selling last week, and we had noticed it earlier. The selling pressure increased afterward, bringing it below $88, and it's now at $84.71. We have our 200-day moving average in this area, which is crucial. If it stays above this level, we might see a rebound from here. Particularly, these tensions in the Middle East can have an upward effect on oil prices. However, as long as it doesn't break above $88, the rebound may be limited. But these recent tensions could potentially create upward pressure on the oil market, which normally should be upwards. Be careful when trading oil downwards. It's a dangerous product with high volatility in both directions. Therefore, I prefer very short-term trading for oil. Natural gas, we've been talking about it here for months, the possibility of movement starting at $3. Then it dropped to $2. We entered and exited positions there, occasionally holding positions, etc., in natural gas. For the medium term, we approached $2, advising to buy as it got closer, sell higher for the short term. It went to $3 and came back twice. Many trades were made. Some of you got upset and quit the game. But look, last week there were sharp movements. And if you have medium-term investors among you who are patient, they made serious money from this, in terms of dollars. And natural gas rose to $3.32 in the spot market. Now, of course, Henry Hub, the price of natural gas traded in the eastern region of the United States, has been much faster and more volatile in Europe. But as long as it stays above my tracking level of $3.13, the direction in Henry Hub natural gas continues upward. And technically, there is potential for this movement to continue up to $4.06. Because now, there's either a reverse head and shoulders or a blessed bull, call it whatever you like, the movement has started. You get results patiently with commodity products, but because commodity products are not like investing in a company's stock. If you invest in a stock, it sinks, but eventually there is a need for commodity products, they press the prices down. Then they raise them again, then lower them again. It's a cycle. So you have to follow certain bands when buying low and selling high. This doesn't work any other way. Oh, it's a quagmire, it's regret. People say about natural gas, oil, silver, gold. Look, this investment method is a bit different. That's why you need to have precious metals, commodities, stocks, and currency in your portfolio. But the trading method for each of them is different. That's why I make various videos and explain it, especially for those who are patient and understand me. My close followers know this. The direction in natural gas continues to go up. Now, it's going to surpass oil. For the past week, there was a move in that direction. In the meantime, you can trade natural gas as a commodity. There are also ETFs like UNG. For example, my tracking level there is $7.30. A good bottom has formed there too, so there is potential for an upward movement. Similarly, there's Bloomberg Natural Gas. But look, it's leveraged, very leveraged. It dropped from $2,460, so I don't want to talk about it too much lately because it's suitable for very short-term investments now. It might be suitable for capturing short-term movements, but only for entry and exit. Because when natural gas prices go down, you see a lot of damage, and when they go back up, you don't get the same percentage gain. Because drops don't give back the percentage loss. So, in terms of short-term trading, it's suitable, as long as it stays above $62.70. Technically, if it goes a bit further up in the short term, follow it. It can move with it a bit, it's a bit risky, but in the long term, it will go down again. But in the short term, it's moving up 3 times with leverage alongside natural gas. So, it can be closely monitored. Uranium, there have been some pullbacks recently, and it's also fueled by tension, as you know. It closed slightly above the $45.25 tracking level. These pullbacks are forming something like a horizontal flag or consolidation. It could be an opportunity too, we'll keep a close eye on it. Because for the medium term, we have targets of $60, $70, and $77.77, but I'm being a bit cautious here. There may be some fluctuations. Let's follow it closely as long as it stays above the tracking level. We are monitoring it through the URNM ETF. I'm trying to compile and explain different products for you. You can follow my broadcasts here every week. I'm also sharing my short-term and medium-term views on YouTube. I will continue to try to keep your path clear in these challenging times. I wish you all very careful and profitable wonderful days.